If you're a coffee shop, you will want to know how much revenue you are recognizing on the sale of one coffee. And you would have thought that's a very straightforward question, because if you're selling a cup of coffee, you know what you're selling it for, should be a very simple transaction. But at SBR, you need to be able to understand and apply the principles of IFRS 15. And in this example, the company, although it sells the coffee for $5, is also giving a coupon, a stamp, a free coffee for every 4 coupons, for every 4 coffees sold. And we are assuming that all the coupons are going to be redeemed. So you're going to have to think. You're going to have to take your knowledge and understanding of the 5 principles of IFRS 15, and let's see if you can come up with the same answer that I've got. When you sell 1 cup of coffee, how much revenue are you recognizing from that 1 cup of coffee? Do you think it is $5, $4, or some other figure? Well, I have an answer, and I also have, more importantly, perhaps an explanation. The answer is $4. But how did I arrive at that answer? What was I thinking of? How can I justify it? Well, in some respects, you've got to think of the idea that you've got 2 performance obligations when you are selling that cup of coffee. Because you're not only selling the coffee, but you're selling, if you like, a quarter of a free cup of coffee down the line. Let's take the totality of what's going on. If you sell 4 coffees for $5, that generates $20. Then you give away 1 coffee for nothing. So you are generating $20 for effectively the sale of 5 coffees. And if you are generating cash of $20 for the sale of 5 coffees, each individual coffee, the revenue that is attached to each individual coffee is $4. So although when we are receiving $5 in the first place for the sale, we have effectively 2 performance obligations. One is to deliver the coffee, the other is the stamp. The other is a quarter cup of coffee in the future. So there are 2 distinct performance obligations here. And the performance obligation for the sale of the coffee now is $4, and the other $1 is the value of the stamp. The other $1 is the deferred income, is the liability. It may not be a liability that you can settle in the form of cash. These coupons, these air miles, you can't cash them in. But from the entity's point of view, they have an obligation to fulfill, and therefore they're recognized as deferred income on the balance sheet. That is, of course, assuming that all the coupons were going to be redeemed, because to begin with, I like to keep it nice and simple. My name is Tom Clendon, and I help students pass SBR.